I will introduce Drew Kyle with Institutional Property Advisors, and he will give an update on the single and multifamily market.
Great job. Well, good morning. I haven't shaved since the pandemic started, so that photo's a couple years old at least. I am excited to be up here in person, though. I did not bring my cardboard double. For those of you that have seen him in the past, he's better looking than I am now, so I just left him at home. But for an industry that had a phenomenal year, when I pulled out this deck, I did absolutely terrible at the 2021 predictions. And just when I thought I was being aggressive, operations continue a steady improvement, but nothing crazy. It couldn't have been anything different. We went from 94.6 occupied to 97.2. We absorbed 50,000 apartment units in DFW last year, and we did 17% rent growth, all of which are crazy. I was pretty close here. Permits have remained a little lower, so we'll skip past that. Value's up 10%, again, probably closer to 25, maybe 30%. We have assets that we sold in 2020 that are literally worth $100,000 a unit more now. And so it's moved that quickly. Projected rent growth wasn't that far off. I think when you look at some of the forward projections, we're in the high single digits. I personally disagree that we'll end up there. I think this year will be double digits again, and we'll talk about that more in a minute. So I apologize. I got much more aggressive for my 2022 projections, so hopefully I'll be more accurate. I saw this slide at our conference last week. I thought it was kind of comical. This is vacancy. The dark green is less than 3% vacancy, the light green is 3 to 4, and the yellow is alert, alert, more than 4% vacancy. That's how healthy multifamily is nationwide right now, that's what we're talking about. You look at Dallas-Fort Worth, I mean, we had to work to find something that we weren't number one at. You know, I really focus more on the top three. This is through November, so trailing 12 months through November, 196,500 jobs in DFW in that 12-month period. 105,000 new people. We absorbed 48,800 apartment units, and we delivered 28,000, and that was a peak delivery year. Obviously, you keep going down the page, the 5-year trailing, the 5-year projections, we're number one of any metro in the country. Looking at kind of the job growth from the pre-pandemic levels. So we lost a bunch of jobs. Where are we now? Net. And obviously, number 3, we're back in the black, even though it's red here. What was interesting, though, is a lot of these are smaller markets, a little more nimble. We are a big ship. It changes dramatically when you compare us to the top largest metros in the country. I mean, there's no one close to where we are as a metro when you look at the big markets around the United States. So huge positive here. You know, where are those job losses, where are the job gains? No surprise, more coastal in nature. And a lot of those jobs come in here to the Dallas-Fort Worth area, the Texas market, and the Sun Belt. Where were those jobs last year? You know, right at the top, professional business services. This is Dallas-Fort Worth wide. You know, those are your higher income jobs. Those are the jobs you want to have. But just broad-based growth in that trailing 12 through November. And you zoom in on the Fort Worth side, this actually is a little unusual. Normally, we lag a little bit on the professional and business services side, so it was good to see us post a big number at the top of the chart here for those more higher income jobs on the Fort Worth side of the metro. And then I've talked about this before, I just think it's relevant in our industry. This is the 5-year projection forward of 20 to 34-year-olds, you know, leading the nation. Houston's a close second, but look at the fall off after that. I mean, 116,000 young professionals coming to Dallas-Fort Worth over the next 5 years. I mean, Phoenix is less than half that, and that's a really high growth market. So it just reminds us, you know, the projections going forward, how important that is for our industry in multifamily, but it also filters out to every other line. Talking a little bit about single family and just housing in general. It's crazy to think that from the prior peak, which is fourth quarter of 2005, our home values in the DFW metro are up 127%. You know, fourth in the country, you know, off the charts. You compare those to some of the markets that got hit a lot harder, and you know, the Floridas, the Detroits, the Baltimores, the DC. Part of it was our values never really went down. I think there was one year we went down like 1%. So it just was a stalling growth where a lot of other markets saw a huge fall off, which certainly helped these stats. We talk a lot about affordable housing. So this is Texas housing in relation to the country. And this is going to be single family. So you look at the jump up, right? Recent single family home escalation, still a massive discount to the national average in some of the other major metros. But when you pivot to multifamily, what we're seeing is that gap is widening to own a home versus rents. We saw 17% rent growth last year. I'll talk about that more in a second. But it's still, we're not keeping up with the cost of owning a home. And then when you start looking at rents, this is the national slide. So you take a look at, this is the percent of your income that you're going to spend on housing in an apartment building. Class C, lower incomes, those costs are high. Nationwide, it's 40%. Class A, nationwide, it's 22% of your income goes to rent. But zoom in on DFW. Class C, it's still a lot. It's almost a third at 30%, but a significant discount to the national average. You look at A, this is your renter by choice. We talk a lot. We were touring a building here in Fort Worth last year, maybe in 20. The manager's like, yeah, we have a lot of young professionals. Well, they're 35 years old making $150,000. And I was like, hey, they're not really young anymore. They're just professionals. I mean, that's who's living in apartments. And so, rent to income in the Class A space in DFW is 15%. I mean, and you jump and look at some of these other major metros, in Miami, Los Angeles, that's up in the 40s. And so there's a reason why you got a lot of talent coming to Texas, a lot of talent coming to DFW. It is a lower cost of living. But you also look at that in the multifamily space, the cost is actually going down on a rent-to-income basis. And while rents went up 17%, if you use simple math, somebody's making $50,000, they got a 10% raise last year, they're making $5,000 more. If somebody's rent is $1,500 a month, they spend $18,000 a year in rent. The rent goes up 10%, it's $1,800. They're still net positive in that same 10% scenario. So, we talk about affordable housing. Multifamily is affordable housing, but again, a lot of the Class A stuff we're doing today is all renters by choice, making a lot more than I think people give them credit for. Supply, this was a peak year, 28,000 units. About 5 years ago, we had 50,000 units under construction in DFW market-wide. That's not a one-year delivery, that's just everything that's actually under construction. That's down to about 36,000 units today, and it's continuing to fall. Easy sites are gone, the cities are challenging, costs are way up, we've all heard it all. And so that was a peak year of deliveries. However, we absorbed 48,800 units. So it was a non-issue. Like I said at the beginning, we went from 94.6 to 97.2 occupied in DFW in 1 year. And still outpacing every other metro in the country. That will slow down. We just don't have the units that people can absorb. So absorption will go down. It's not a bad thing. When you're 97, you can only get to maybe 98. You still have to turn the units. And it speaks to just the strength of the market. I mean, you would never think, as you see the vertical bars of construction go up and stay elevated for years in that 26 to 28,000 range, that you'd see vacancies actually fall, but that's exactly what's happened. And it's going to take us a while to get back to that level of supply. 26 to 28,000 permits a year up through 2019. 2020 was 15. 2021 will probably end up at 22,000. And even though developers are out there working their tails off to go find new sites, it's going to be tough. So we're going to be entering a cycle of underdeliveries at 97% occupied, which will lead to continued rent growth, which is my comment earlier. I think will outperform the projections of go-forward rent growth because we're full, and rents will move. These are the slides I'm going to get made fun of for. I'm sorry, it's comical. We're blessed to be doing what we're doing in the multifamily space. This is vacancy, Dallas, Fort Worth, and nationally. I mean, just vacancy's fallen off a chart. You look at it in the A, B, and C space, it's everywhere. It's not just A, it's not just C. Everything's gotten tight. We've got a workforce housing problem, and we have a housing problem for a place for people to live. This is rent growth. What was a little unusual last year is that if you look at the next slide, on the A space and the B space led, for most of this cycle, the workforce housing was super tight because you can't go back and rebuild workforce housing. You've got 70s, 80s, 90s product. You can't go back and rebuild that. So if people need that, $1,200, $1,300 rent, or in an 80s deal, a $900 or $1,000 rent, you can't rebuild those buildings. So those buildings were tight. And so most of the cycle, the C's actually were outperforming the A's and the B's. The A's were struggling because you had a lot of new supply. Well, last year, all that new supply got absorbed. And you've got a renter by choice that's paying 15% of their income to rent, they can pay it. So last year was led by A's and B's, and you kind of look down at the C's and go, okay, well, what happened? There's no question that sector got hit harder. I mean, that's a lot more service industry, retail, people that got laid off. It generally had a little bit higher delinquency last year, but again, the delinquency in DFW never really moved a lot during this pandemic. If it was historically half a point to a point, it might have peaked at 2 or 3%. And that was for kind of a brief window, and then it's come back down. We do think this will go up. Wages are going up in the workforce sector. We all know it. We've talked about it today multiple times. You know, to get a job at any retailer now, you're going to get paid $15 an hour. You know, that was probably $8 pre-pandemic. So the C space will see recovery, you know, as folks are weaning off maybe some government support. They're getting back to work. They're going to get back to work at higher wages than they were before. That's going to allow that C space to lift, but it's not going to catch up to A's and B's. It might be 6, 7% this year. My favorite market, Burleson, Johnson County. Every year I've ever done this, it's been at the top of the list. It's just full. It can't get any more full, but somehow it got more full last year. 98% occupied. To me, a lot of these slides are just more macro. I mean, the entire Fort Worth market's 3.1% vacant. The worst market, East Fort Worth, is 4.1% vacant. You know, you look at in-town Fort Worth, the market that we all drive through, you know, coming and going from this event today, you know, that market tightened up 3% last year. And you look at rent growth, no surprise. Grapevine, South Lake benefited probably a little bit from really high-end new supply that, you know, was setting new record rents, so it kind of lifted all boats. But every market top to bottom, again, the worst market, a workforce housing market, by the way, East Fort Worth, 7.1% rent growth last year. In-town Fort Worth, notably 15%. You know, we think in-town's really set up well to take off because the supply has fallen off a map. This is that map. 3 years up and through last year, we had 5,000 units that hit, you know, call it the greater Fort Worth urban core. I was saying, you know, this is all a 10-minute drive time from the heart of the city. Going forward, we have 2,000 units. I mean, supply's down 60%. And frankly, a lot of those 2022 deliveries have already been absorbed. So this is where, you know, we're well positioned in the center city that had been a little soft to really see a good run in rents going forward. You know, this will lead to incremental new supply, but again, it's tough. The easy sites are gone, costs are way up. But I know we get, you know, asked a lot. It's like, man, it seems like there's an apartment deal popping up everywhere. Yeah, and they're all full. And that's allowing people that work at Lockheed to have a place to live. That's allowing people that are coming in to work at the Med Center to have a place to live. I mean, the job base here has been significant. And we're also kind of a hub and spoke market. You know, if you want to live in the urban core, and maybe you work in Arlington, maybe you work in North Fort Worth, and certainly Arlington's up and coming with a lot of positive things there that attract people to want to live in Arlington. But, you know, the center city of Fort Worth is that hub and spoke for the Tarrant County market, where Dallas might have Uptown, Richardson, Plano, Frisco, Las Colinas, Addison. There's multiple little sort of urban nodes that are out there. So closing out on sales, this is cap rates. Since 2012, the dark green cap rates have dropped 200 basis points. Certainly you see it in the Sun Belt, and it's more normalized. My West Coast guys that always, you know, were proud to be working in San Francisco, and they were 3 caps and we were 5 caps. Now they're angry that Texas is the same cap rate as San Francisco. They don't get it. I love it. It's a blast when we get on those national calls. And kind of like the supply, you know, vacancy chart earlier, no surprise, cap rates are compressing, values are going up. The macro data is always a little off. I'll just say if it's anywhere from a decently located 70s or 80s apartment building up to brand new core, cap rates are in the 3.5% to 4% range. And that's one reason why you've got a lot of capital that maybe was doing 70s and 80s value add is now buying newer products. They're going, man, if I'm going to pay a 375 cap, I'd rather own newer. But there's still, you know, that workforce housing space is still strong. There we go. And then I think last thing to close out on in terms of cap rates, you know, everybody asks, interest rates are going up, or cap rates going to go up. I think there's 2 things there. One, as you can see, that spread is still quite wide of the historical. There is a general correlation. There's not a direct correlation. So in our world, we feel like with the operational stability we have, the rent growth we have, we're not going to see cap rates and pricing really get impacted in the near term by interest rates. Over time, it might evolve. But I think we've got a lot of room to absorb higher interest rates in multifamily because people want to be there for the growth. And it gets back to just what are those total returns? You know, if I'm an institution, if I'm a pension fund, if I'm a endowment, where else can I get a return that I can get in multifamily, even if that return continues to shrink? And so it's been a huge support for us. I messed it up. This should say 2022. Man, these projections, both slides, I'm really screwing up. I'm going to say 14% rent growth. Again, I think if you look at the third-party data, you're going to see a lot of 7s and 8s. I disagree. I think we're too strong going into the year. It's going to be too strong of a year economically that we're going to outperform what a lot of people think. We will break the $3 rent mark. Most of your urban core products in probably the $2 to $2.20 range, we're going to see big moves in that in-town product. It goes back to the lack of supply. Permits will increase. I think we'll start to see a lot of those start to pop late this year into early next year as guys are scrambling to get sites done. But again, that's a 20 to 30 month delivery cycle. It's not like they're going to hit the ground and start leasing day one. And lastly, values are going to be up another 20%. I hope that's the case. I appreciate everybody's time.